All right. Lou, do you want to introduce yourself and tell the good people where you're from?
Yeah, I'm Lou Pacelli. I'm the founder and CEO of Navigator CFO. We are a fractional CFO firm. We provide chief financial officers on a fractional interim or part-time basis to smaller companies that don't have the capability to pay a full-time investor. I'm located in New Jersey, northern New Jersey, right outside of Manhattan. That's our market. Although we can work, I prefer to work in person, but we can work virtually as well.
Excellent. So today we are going to dive into your experience in the wholesale and distribution markets. Lou, let's start with some of the challenges that face businesses in wholesale, in distribution. You laid out a few here. Let's start with inventory glut and shelf life issues. Can you kind of state what that challenge is and then break it down for us?
Yeah, well, inventory is kind of tricky. It's got to move. If it's not moving, you're dying. You're wasting cash. If it's sitting in the warehouse, it's costing you money. And ideally, you want to do just-in-time purchasing where you're buying it to deliver it. However, most of the time you have to keep stuff in stocks so you can fill orders that come up spontaneously that you're not ready for necessarily. So you have to maintain some stock. But you want to keep that to a minimum because you don't want to tie up the cash.
So, what are some examples in your experience? What are some industries that you've had experience with? You mentioned the food industry and how that's different from commodities.
Well, food could be a commodity. It depends on what it is. Prepared food obviously is not a commodity. Frozen foods are not a commodity, they're prepared. So there's some manufacturing in that. If you're selling like produce and stuff and you're taking it from the farm, that's sort of like a commodity product. With the food industry, you have to worry about shelf life. That's even a bigger problem because you don't want food to go bad on you. So you have to really make sure you can move it fast. There are other challenges there as well. Manufacturing food, in other words, adding value to food, like taking potatoes and making French fries, taking beans, carrots, and vegetables and making mixed vegetable frozen packages, so to speak. So there's a lot to that.
So, Lou, let's talk about technology and an obsolescence in the technology industry and how that might look in some other industries as well.
Well, I've done a lot of work with hardware technology in warehouses, and the thing with that is obsolescence is I think most people know. Like I've done work with cell phone wholesalers, and we all know that our phone is after a couple of years is not as valuable, so that has to move. And if that stuff sits there and it doesn't sell, you have to have a way to get it out, sell it back to the manufacturer, have a deal with the manufacturer where if it doesn't sell, they take it back, they recycle them. You have to have those negotiated up front because you don't want to be stuck with this inventory that's going to sit there, and you may not, there's whole nother issue with not throwing it away. But eventually, but that's what you may end up having to do, and that's a hard thing to do when you've paid good money for it originally.
You mentioned that you had some experience with ADT security systems. I think that would be relevant for our listeners.
Yeah, earlier in my career, I spent time as an accountant mostly for manufacturers and wholesalers. There were other ones, but the big one that I worked with was ADT security systems. And we managed the inventory there, and there was manufacturing involved in that because they actually were a large multinational company where they manufactured the products they sold as well as wholesaled it. We always had to manage the inventory in a sense that it was going out of style or it was going obsolete. There's always new technology coming up that would replace it, so we had to either move it out. And over the years, since that was an older, well-established company, there'd be a lot of stuff that would just accumulate, a lot of old components that would just accumulate. We would have to, and there'd be no place to really pawn it off because we were the manufacturer too. So, it was like you say, send it back to the manufacturer and they'll take it and recycle it, but we manufactured it. So what are you going to do with that? You just have to destroy it and get it out of your warehouse at that point. and write it off. And that's always, that, depending on how much that is taking that all that stuff off your balance sheet and hitting your income statement with that, depending how large it is, can really hurt your bottom line.
So it sounds like shelf life issues aren't unique to the food industry.
No.
They're not unique to the technology or hardware industry. You also have some experience in the fashion industry, and I'm guessing that there's a continuous thread there.
Yeah, I don't necessarily call it the fashion industry. It's kind of a component of it. It's the garment industry in general. It depends on what you're making, but like for example, women's fashions go out of style every year. So you have to constantly keep up with that. You have to buy. Fashion buyers know this. Manhattan fashion buyers know this. They live and die on buying the right amount of inventory of a product and knowing whether it's going to sell or not. That's what a CFO does. You got to work tightly with those people, the buyers, the purchasers, make sure that they know that this product's going to sell. Now, you can't know everything. You don't know what's going to sell more than the other, but a lot of it's a guessing game. But you have to make sure you have the right people in place that know the market well enough to say, well, I think this is going to go for this reason. Where they're obviously they're making a guess, but they're not making a blind guess. There's educated guesses. There's experience there. So you need that. We need to work. Us finance people need to work closely with those people to make sure that happens well, so the inventory could move. Having said that, like there are other products like sneakers, for example, that don't change as much, that you can easily sell a year later or something. But they do come out with new stuff because marketing always does new and improved, and they always want to sell the newest and the hottest. So that becomes not an issue, but you want to get rid of the old stuff too. But there are ways of doing that. You could sell it, you go from like the tier 1 retailers to the discount retailers, but there's downside to that too, because then people know that in a year this product's going to be a lot cheaper and they just won't buy it. And if they do that on scale, that could be an issue.
Yeah, well, you're always going to have that segment of the market, the laggards, the ones that are going to wait, but you will always have those early adopters who want the newest and latest greatest thing.
Yeah, so you have to cater to both, and that's really how it works.
Yeah, so it's almost like these businesses, they can't afford to have a hoarder mentality. And we talked about this a little bit. What is that? How does that hoarder mentality kind of seep into business operations that you've seen in your experience?
This happens primarily in smaller businesses. It could be family-owned businesses. It could be just smaller operations, what we call closely held businesses, or private businesses, where the owners tend to not want to let go of the inventory. They want to hang on to it. And I call it a hoarder mentality because, we all to some degree are prone to it. We keep stuff. And in a business, it's, in business as in everywhere else, it's costing you money. It's costing you money to maintain that stuff. It's you need space, which costs you either rent or taxes or whatever if you own it outright. It costs you something originally, so the carrying costs for that stuff. And it also costs you dearly. You don't want to write it off. A lot of times it's kept there, not necessarily because of a herding mentality, but it's too much money to write off on your balance sheet to take a hit. So you have to take it slowly over a course of a couple of years versus taking the hit all in 1 year because it'll wipe out your profit.
So whether you're distributing food, which has a shelf life of maybe weeks, or technology, which has a shelf life of maybe 18 months, yeah, or women's fashion, which has a shelf life of up to a year, in any case, there is this cycle that needs to happen where you purchase inventory and it moves through. So, Lou, let's talk about that cash conversion cycle. What is a cash conversion cycle, and then how does that apply to manufacturing and distribution businesses?
Ultimately, what the cash conversion cycle does is it tracks your cash flow. Now, what you got to do is from beginning to end, you have a timeline, right? You create a purchase order, right? You buy inventory, assuming they're manufacturing it, they deliver it, it comes into your warehouse, you get terms to pay for it. So there's no cash out yet. You put a purchase order in, you ordered some stuff. The manufacturer makes it, they deliver it to you. You got, I don't know, 30, 60, 90 days to pay for it. They give you terms. Now, in 30, 60, 90 days, you pay for it. That's the point where cash goes out. That's cash outflow. Okay, so now you got the purchasing period. Okay, then you have the cash goes out. Now you have the sales cycle. Now you have from the time it comes into the warehouse till you sell it is a certain amount of time. So you got to track that time, days to sale. Okay. Now, just because you sell it necessarily, if you're a wholesaler, you don't, it's retail gets paid right away. They swipe a credit card and they get paid. But if you're a wholesaler, you generally give your retailers that buy it terms. So now you delivered it to your retailer, right? And they have 30 days, let's say 30, 60 days to pay. Now you have like, I don't know, X amount of days to sale, and you got 30, 60 days to get paid. So that time frame now till cash in, you have to measure. And okay, now you got cash in, then you start the cycle over again. You take that cash to purchase again. That whole time frame is called your cash conversion cycle. And you want to measure each component of that. You want to measure days of sales versus days in inventory versus days to get paid. And you create a total days for the whole cash conversion cycle. And say it's 100 days. Well, now you want to compare that to industry standards and say, okay, in this industry, that's 100 days is the standard, or 100 days is above the standard. Or you might be aggressive and say, yes, it's the standard, but we want to do better. So how do you shorten that time? How do you shorten any amount of time in that cycle? You can shorten your terms, but then you may annoy your customers. You could extend the time you pay, but that might annoy your suppliers. So it's a balance. It's really a balance. You may only be able to shave a couple of days or a week off, but it's better than nothing. You want to try to, it actually exponentially adds value to shave even a couple of days off or a week,
So what I'd love is to illustrate it a little bit. Let's add some contrast to it. So scenario one, you have a healthy distribution business who pays for purchase orders with cash from their cash conversion cycle. Cash in, they reinvest that cash to purchase orders, right? Scenario two, the cash conversion cycle is longer than their buying cycle, so they're going to need to finance purchases. Okay? So given those two scenarios, what is the long-term financial impact of both of those scenarios?
Well, it doesn't have to be negative. Here's the thing. Like if you can't shorten your conversion cycle, there are ways, and again, it's what a CFO does. There are ways to not necessarily shorten the cycle, but to finance the cycle. And that's through lines of credit. You may need to establish a line of credit till you get paid. There are certain industries, if you're a manufacturer, they don't get paid. A lot of times they have 100-day terms. They don't get paid for 100 days. So they got to tap. So for that time, they got to tap into their short-term line of credit. Now there's a cost to that. There's obviously you want to always pay with your cash flow, because that's not necessarily, that's freer money. That's free money. That's your money that you're paying with. And it's cheaper than borrowing the money because you're not going to be paying interest on it. But when push comes to shove, you need to do that. It's still better to have that liquidity available, even if it costs you a little bit in interest. So there are ways to free up that liquidity through structured financing.
So ideal scenario, it sounds like purchase orders are funded with cash, but there are scenarios where it does make sense to have some sort of financing to help smooth out the edges, so to speak.
Yeah, a lot of times you can't, as hard as you try, you can't shorten that cycle anymore. You're just where you are. That's it. That's your business. That's your model. You get to the point where you do everything you can. You always try to, but you can't shorten that cycle anymore. Then you have to go for financing.
And that can look different from industry to industry.
Yeah, it's generally the same. It's generally short-term financing. The question is, what's the collateral and what's the quality of the collateral? But that's really the difference, because your collateral could be accounts receivable, and I've done this, asset-based lending it's called. You finance it with your receivables or you finance it with your inventory. And it depends on the inventory. Obviously, you can get a bigger line of credit against commodity inventory than you can against highly manufactured inventory, like especially very specialty use stuff that has a very specific buyer. The best inventory to use as collateral is always commodities. There's always a commodity because it could be liquidated easier. The best receivables are the shortest receivables, the best payers. If you have receivables running over 90 days and they have to pay in 30 or 60 days and they're delinquent, those are going to be eliminated. So you got to make sure you don't keep bad receivables on the books too long. You have to get them out. You have to, collect that money somehow, or get rid of those customers if they're not paying well.
So asset-based lending is a way for distributors, wholesalers to use their inventory, to use their accounts receivable as collateral for loans, for lending. What are some other ways that these kinds of businesses can manage their cash flow? What other levers do they have to pull that you can help guide these businesses to do?
The other way, a lot of these businesses own the buildings they're in. And that works that helps too. If they're an older business and this warehouse or this flex building has been in their family for a bunch of years or been in their business for a bunch of years, and say it's owned, a lot of people pride themselves on the fact that, it's debt free, we own it. However, you can use that as collateral to get a longer term loan, to get a line of credit, and brick and mortar is always a better form of security for a financer than volatile receivables or inventory. So that's always an option. And it comes down to what's the quality of your collateral, and that's a decision. That's a decision you have to make early on in the business.
Mm-hmm. And what about inventory audits or the age of receivables?
Well, inventory audits, when you do an asset-based lending, inventory is audited regularly and receivables are audited regularly. Banks don't always do this. This is more like non-bank financing. However, there are banks that do it, but they'll send out third-party auditors to evaluate your receivables and evaluate your inventory periodically, make sure the inventory that you report, because you're reporting it on paper. They don't know if it's there or not. Gotcha. So they have to go out there and periodically see it and touch it and, make sure it's not what we talked about earlier, obsolete, and it's actually current inventory. That's another issue with asset-based lending, is the inventory may be obsolete as well as the receivables being aged too old.
So what's the value add of a CFO when it comes to asset-based lending? How can you help structure that deal in a more positive way, or how can you help kind of retain more cash flow for your clients?
Well, you have somebody in-house that knows where the pain points are as far as collecting receivables. Asset-based lending is very labor intensive. You have to have somebody on top. You have to have staff on top of those receivables daily. The inventory, maybe not daily, but you have to be watching it. You have to be, daily in a sense that you have to make sure it's moving. You got to look at that timeline we talked about, that cash conversion, make sure that most of the inventory is moving within, a reasonable amount of time, within like 30, 60, 90 days, it's moving in and out. You need somebody in-house to monitor the obsolescence. You need somebody in-house to monitor the value of it. Again, it runs the gamut of the department. It's not just finance and accounting people. It's warehouse operations. You need to work with the COO if there's a COO, Chief Operating Officer. You need to work with marketing. You need, how do we move this stuff out? So having somebody there that's not the CEO that's wearing all these hats definitely takes the load off.
There's a difference between growth and scalability. How can you, as a fractional CFO, help wholesale and distribution businesses scale proportionately?
Well, scaling is about bringing new product to market. Where growing is selling more. Selling more is not always, you talk to a marketing person, it's sales, 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 sales. It's all about the top line sales, gross revenue. You talk to a finance guy like me, yeah, that's important, but it's also important to manage costs, to keep that bottom line number, to keep net profits in control. Now, granted, I'm not adverse to spending money necessarily, but you got to spend it wisely. Each dollar you spend is giving you the return on investment you want. So you really have to do that analysis. And that's where a good CFO comes in and says, okay, we're going to spend money on this, say, for example, technology. Well, what's the return on investment? What's it's going to save us in people and time, or are we going to be able to free up somebody to do something else? That's where you have to look at the whole picture. There's an example where you have receivables on the books. Okay. Now, a good analyst or a good CFO is going to say, okay, from period to period, from this quarter to the last quarter, receivables grew by 10%, right? Receivables meaning, you're waiting on this cash to come into the house. It grew like 10%. But your revenue grew by 5%, say, or grew less. Well, now you got a problem because your receivables, you're not collecting your receivables fast enough. So you have to really look into that. And those are things that a trained eye is going to see on the balance sheet that they're not going to see, that a non-financial person is not going to see. Now, I'm not saying that operational people, a lot of COOs are from the finance world. A lot of marketing people, have business degrees and have an understanding. You need to have a basic understanding of that stuff. But more importantly, you have somebody committed to looking at that.
And understanding where to look and what kinds of trapped cash you can unlock.
Exactly, because that's not necessarily the C. While they may know about it, that's not necessarily their main objective.
As a fractional CFO, you're helping those COOs, the CEOs, the controllers within those businesses. You're helping them find areas where they can free up cash for cash flow, make the business a little bit more flexible, so that it can make those investments in entering new markets or bringing a new product offering to market or increasing their market share.
Well, that's an example of wise spending. It is spending, but it's reinvesting your money. It's reinvesting in future income, whether it's a few months down the road or 6 months down the road. That's wise investing, is like freeing up money to scale, meaning freeing up money to bring new product to market, to create a new area of the business, even a division or a new product line. Those are really where you want to focus, and that's scaling the business. That's scaling the business. That's and that takes a lot of work, in a sense that you have to really dig into the numbers and free up cash wherever you can. And that's it. It's always the same thing. Cash is king.
Cash is king. And that's where the value of your experience in industries like wholesale and distribution come in handy, is because you know exactly where to look to free up those areas of cash.
Yeah, to the extent that you can, and then you got to do some creative financing to figure out where you can't necessarily, holistically free up cash, if you will.
So let's talk about another value add as a fractional CFO to businesses in the wholesale and distribution markets, and that's negotiating contracts with banks, lenders. So what are some key areas where, or maybe some examples where you've helped those kinds of businesses negotiate better terms?
Well, in asset-based lending, the terms we negotiate are the terms. I mean, whatever the market is on the rates, you're going to negotiate, but it's really more about structuring the financing and getting it done. If you're in a high interest rate environment, it's going to be higher. If you're in a low interest rate environment, it's going to be lower. You can control that to some extent by the quality of your collateral and the quality of your business. So again, just like I spoke about earlier, you can put a bank or a financer at ease if you have good financial reporting and you have good accounting. You have a good accounting staff that can provide the reporting that they look for in the format that they want in a timely manner. When you're delayed, when you're giving them receivables that are taking forever to come out, well, then they lose faith in you, and you're not going to get the best terms. You're not going to get the best rate. They're going to say, okay, we'll finance you, but it's going to be X amount of dollars, because they can't trust you to get it right. But if you're on top of it, and if you're showing you're very structured and you have the right people in place, and I'm not just talking about a CFO, because a CFO generally is looking at things at a higher level. They're not hands-on necessarily in the accounting function. So you need a good, accounts receivable clerk. You need a good accounts payable people. You need a good controller, or at least an accounting manager managing the staff that's controlling the closing process and getting it done timely. If you have all that in place, it goes a long way in building credibility with your financial institution.
So, Lou, can you tell me a little bit about factoring? What is factoring?
Factoring is different than asset-based lending. It's done in manufacturing. It's done in wholesale and distribution, where you literally there are factoring companies. You literally take your receivables and you sell them at a discount to a factoring company. You're not borrowing the money per se, you're selling the asset. So now they own the receivable. If it's say it's $1 million in receivables, they may pay you $800,000 or $900,000 for it. So you take a haircut, but it's better to take a haircut and get $800,000 or $900,000 today than wait, and you'll probably get maybe $800,000 or $900,000 down the road anyway, because a certain amount of people aren't going to pay, or they're going to delay even longer. In the long run, it's better to take the money now. So that's an option if you can't get asset-based lending for some reason. Maybe you don't run as tight a ship. That's like a secondary option. You don't necessarily want to do that. You want to go the route of, obviously, it goes in the order. It goes in this order. You want to pay with cash from collections. If you can't do that, you want to do an asset-based deal with a financial institution where you're establishing a line of credit in place. And if you max that out, I mean, you could have both. You could have situations where you're maxed out on your line of credit, you can't get any more, and you have some old receivables, that you want to get off the books. You sell it to now if you have old receivables, when I said they'll drop it by 10%, they may drop it by they may only pay you 50 cents on a dollar. You know what I'm saying? If for old receivables, because the odds of them collecting that are a lot less. But they're old receivables that nobody's paying, so it's better to get 50 cents on a dollar than nothing at all. Or at best, maybe if you do the collections yourself, besides your staff's time, you might not even collect 50% of it.
Paying with cash, asset-based lending, and then factoring as kind of a last resort to help clean up the aged receivables.
Yeah, or you always want to sweeten the pot, because a factor is not going to want to buy all your junk. So you want to sweeten the pot with some good receivables as well.
Mix in some good ones. Throw those factoring businesses a bone, right? Lou, for folks that maybe there are some controllers within some distribution businesses that are watching or listening to this. If they want to work with you, where can they find you?
They could find me at my website. It's navigatorcfo.com, and they can come through there. I'm available on LinkedIn. My name is Lou Pacelli, so you can look me up on LinkedIn. I'm pretty active there. I just want to tell controllers out there that I'm there to work with you. That's what I generally do. I don't, because a lot of times you come in as a CFO and the controller thinks that they should be the CFO. We need both. We need somebody doing the accounting and bookkeeping and stuff. Not that the controller is doing the bookkeeping, but they're managing the staff. And you need a CFO that's looking at high level functions and driving the business in the direction that the CEO wants to go.
You're an ally to those controllers.
That's what I want.
You're not an adversary.
Yeah, that's what I want to be. I don't want to be an adversary.